One category of cryptocurrencies is about to disrupt the traditional banking sector and payment processing giants like Visa and MasterCard. These are stablecoins. The issuer of the second most popular stablecoin, USDC, Circle, went public last month, making the biggest crypto IPO since Coinbase in 2021 and raising $1.1 billion. Its stock skyrocketed 700% before a sharp pullback. So is this just another hype cycle, or is it something meaningful about to change our world? In this video, I will explain what a stablecoin is and why it matters to investors. In this channel, it's all about investing and personal finance to help you achieve financial independence. The goal of the cryptocurrency industry is to function independently of the central banking system, eliminating the need for fiat currency in its ecosystem. However, most cryptocurrencies have been highly volatile in the early stages and still are today. Traders often need to convert their holdings to fiat money. Stablecoins were created to solve this problem. They allow for crypto transactions to settle in a common denominated asset without converting to government-issued currency. They were designed to be stable and serve as a store of value because issuers claimed they were packed one-to-one to fiat currencies like the US dollar or short-term US Treasury bills. But that's not always the case. A well-known stablecoin, TerraUSD, lost nearly all its value in a massive crash that wiped out an estimated 50 billion of investors' money. Unlike the more popular Tether and USDC, Terra wasn't backed by US dollars. Instead, it relied on a complex algorithm tied to another cryptocurrency. That lack of real backing was a key reason Terra collapsed, triggering a loss of investor confidence. However, stablecoins have gained broader acceptance even beyond the crypto community. They offer several advantages over traditional fiat currency. No bank account is needed. Peer-to-peer transfers settle in seconds at a fraction of the cost of wire transfers. And they work globally, 24/7, anywhere with an internet connection, without cutoff times or regulatory restrictions on wiring and currency exchange. They can also be integrated into programmable smart contracts to automate payments. Most importantly, they preserve value, making them especially useful in countries facing hyperinflation or currency instability. The recent passing of the Genius Act in the US Senate marks the first federal framework for regulating stablecoin issuers and users while protecting consumers and financial systems. One important provision of this legislation requires issuers to maintain a one-to-one pack with US dollars or similar liquid assets like treasury bonds. Following the reciprocal tariff announcement in April, we saw a sell-off in US treasuries, raising concerns about the weakening dominance of the US dollar as a global reserve currency and whether foreign lenders will continue to fund US debt by buying treasuries. The eventual passage of this legislation will likely boost global adoption of stablecoins, creating new demand for US dollars and treasuries. Treasury Secretary Scott Bessent recently stated that he believes the stablecoin market could reasonably reach $2 trillion in the coming years. That's nearly 10 times today's market cap of around $250 billion. If that plays out, it could be a decade-long opportunity for companies positioned in this space, and more importantly, for investors. E-commerce giants Amazon and Walmart last month announced plans to explore issuing their own stablecoins for payments. Their main goal, to bypass the middlemen, credit card networks, and potentially save billions in transaction fees each year. On average, Walmart pays over 2% of each transaction to Visa and MasterCard. No surprise, both stocks dropped sharply after the announcement. So as an investor, how can we benefit from this opportunity? First, I wouldn't count out Visa or MasterCard just yet. Both companies are actively working on stablecoin-based payment offerings and upgrading their digital infrastructure. For example, Visa is piloting payment settlements using USDC. MasterCard has developed its own multi-token blockchain for B2B payments. And let's not forget, consumers love the perks of credit cards. I don't expect overnight changes in how people pay, especially in developed economies. I personally own both MasterCard and Visa, but to reduce potential risk, I plan to exit my position in Visa while holding on to MasterCard and increasing my stake in this stock I'm about to share next. Now let's talk about Circle. Is it the right time to jump into this hot stock following its successful IPO and passing of the Genius Act? Not so fast. Instead, I believe Coinbase, the stablecoin USDC's primary distributor, is the better investment. Here's why. Although Circle launched its own payment network, CPN, in May this year to eventually challenge Visa and MasterCard, the platform is still unproven. Currently, almost all of Circle's revenue comes from interest earned on its dollar reserves held in short-term treasuries. A drop in interest rates would significantly hurt its income. Plus, according to their partnership agreement, 50% of that revenue is shared with Coinbase, the co-founder of USDC. So as Circle grows, Coinbase benefits without taking on the same capital expenditure. Coinbase offers a much broader range of crypto-related products and services. It's the largest crypto exchange in the US and the biggest custodian for Bitcoin ETF providers, which means most Bitcoin ETFs offered by US financial institutions like BlackRock's IBIT keep their Bitcoins at Coinbase. Recently, Coinbase also launched the Base Network, a USDC-based payment system integrated with Shopify, providing a fast, low-cost payment option for millions of merchants. Additionally, Coinbase is also seeking SEC approval to offer tokenized stock trading, where shares are represented as digital tokens on the blockchain. This could revolutionize the way retail investors trade stocks. Tokenized equity transactions would settle in near real time compared to today's standard one business day delay. This would enable almost instant cash redeployment or reinvestment. Finally, stocks could be traded 24/7 without relying on centralized stock exchanges. With support from the current pro-crypto administration, I believe SEC approval for Coinbase tokenized stock trading is highly likely, especially after Robinhood announced on June 30th that they began offering tokenized US stocks and ETFs across Europe. As Circle becomes more successful with USDC and CPN, Coinbase benefits automatically through its revenue sharing model without the direct risk. That's a better, more diversified business model. You can think of Coinbase as the Amazon of the crypto industry and potentially a major disruptor of traditional finance. With a current market cap of around $90 billion, I believe it's a strong investment for long-term growth, especially as the US moves closer to becoming the crypto capital of the world.